Apart from IndusInd, SBI is the other big one. While the private sector large banking names have been struggling yesterday and this morning, SBI is trying to offer a counterweight. The market's still down about 20-odd points. Seems to be some selling in large cap IT and Reliance as well. We'll see how it goes, but it's a very quiet start to begin with, guys.
Well, IndusInd Bank is your top gainer. It's not a blockbuster move. It's a sedate 1% gain. But that's the top mover right now on the back of Rajiv Anand's appointment as the CEO. 1.5% up on IndusInd Bank. The other notable mover is Bharti Airtel. Remember, it reports numbers later today. Numbers come out post-market hours. Airtel Africa, which is about a quarter of the company's overall valuation and numbers, came out with a very good set of numbers led by tariff hikes in Nigeria. Bharti Airtel's India mobile business performance will be tracked very closely. Coal India, Jio Financial, Ultratech Cement, Eternal, NTPC, these are some of the stocks on the gainers list. On the way down, you've got some large cap IT names struggling a bit. So Infosys, Wipro, TCS down between 0.5% to 1%. M&M is down nearly 1%. You've got HUL, which is correcting after the big up moves, and lots of brokerages came through. Stock did well, but now it's seeing a bit of a profit booking. Axis Bank is weak in trade. And you've got Reliance Industries struggling. All in all, it's a very weak. It's a sluggish start, very lackluster. You've got a little bit of a red coming through on the Nifty and the Sensex. Banks are underperforming a bit.
Well, I think a bit of a pause for breath after the kind of run that we saw yesterday is par for the course. We need to take out higher levels, and then in fact you'll feel a little bit more confident. But let's focus on a few stocks that are buzzing around. Oswald Pumps, I think they came out with a set of numbers. The street likes it. That stock is reacting positively. AB Capital and Ather Energy, both of them, they had a good run yesterday. They're seeing some kind of follow-through buying today. So both of them, initially, volumes are pretty okay. And both those two stocks were up. Oswald Pumps, yeah, that's reacting to its numbers. The other couple of stocks that are doing well is Sanofi. Pull up that stock, that's buzzing away. And Godfrey Phillips as well, as Mangalam told us, is smoking hot. I recall when Philip Morris came out with its set of numbers as well, we said the read-through could be that Godfrey Phillips could have yet again outperformed what the market did. And that seems to be the case. So that's opened up, gap up 6% higher. PSP Projects. Yesterday we had highlighted the stock was down close to around 18% in pre-open, and there could possibly be a large trade in the offing. Well, in the second half of trade yesterday, we did see that the Adani Group went ahead and picked up that chunk in the stock. For the time being, the stock opens up with a gain of close to around 5% now that that last trade is out of the way. What's not doing well? Triveni Turbines reacting negatively to its numbers. So that stock is lower. TBO Tech, that's the other one that's reacting negatively to its numbers. And Bosch as well is down close to around 2.5%. Keep in mind, Bosch in the last 3 months has seen a very, very big run. It's coming for some profit taking in today's trading session. And because of this tariff worries and the talk surrounding it, we have a stock like Gokuldas Exports that continues to reel under pressure. I think Gokuldas Exports, Welspun Living, because of the kind of exposure that they have to the United States. India's talking tough, and rightly so. But it seems that these guys who have a high amount of their exports out there, these stocks are a little under the weather today. But IndusInd Bank now is building on the gains, holding with a gain of around 2.5%.
Looking good. We should pull up Gokuldas. That's the stock that Nigel was just talking about. Some of these textile makers, exporter stocks, they're under pressure because of the kind of rhetoric that we've seen overnight as well. And by the way, on the gaining side, look at New India Assurance, 4% gain coming through on that one. Team Lee is about 3%. So it's a little here and there. But otherwise, the market is largely flat to begin with.
Is also one more stock you should watch. Down straight away, 7% lower, very large volumes. Again, here, it's an earnings miss. Revenues were down about 20%.
Absolutely. So a lot of individual counters in focus on the back of either news or earnings. Overall, market remains range-bound this Tuesday morning. Let's welcome in our next guest on the show. We have Samir Arora of Helios joining in. Samir, great to have you on. Long time, haven't spoken to you. I like the frames, new frames, I think. So wonderful.
I've been roaming around India and the world, so yeah.
Oh, okay. A new perspective, with looking at things with a new set of eyes, as they say, right? But I don't know. Are you finding anything new? I mean, we'll talk about Trump and tariffs and all that rhetoric in a bit. But let's talk earnings first, because I've been looking at a lot of notes in the last 24 hours. And the general sense when you read these sell-side notes is, itna bhi kharab nahi hai, Q1. But you tell us, what's your assessment?
Actually, the thing is that if you keep looking at the old companies, then kafi kharab hai. But there are so many interesting companies, and the ones we own, all of them had massive results, like massive growth at least. And in an environment where growth is very limited otherwise, you need at least 10-15% of your portfolio, maybe even 20% in 5-6 stocks, which are, you are looking forward every day to what they will do in 2 years and 3 years, instead of saying that, some company has guided for 1 to 3%. Now it is making it 2 to 3%. That kind of boring things you can handle only up to a point. So actually, if you look at the entire menu of choices, there were many companies that have done well, but in aggregate, it is nothing great, but it's not bad. It's like 9-10% type of, aggregate earnings growth, which is okay for now, for if it is, as long as it's for 1 or 2 quarters only.
So where does that leave the market then? I mean, again, I'm just leaving aside the whole tariff issue, but with these kind of earnings and the cuts so far for full year are just about 1%. Most brokerages have cut by 1.2, not more than that. So where does that leave us in terms of market valuation? Any upsides or no?
So the upside isn't that you'll get 10%. If you see the big pools of earnings, so IT is growing maybe 3-5%. Large consumer is excited if they grow 5%. And the large banks are growing 8-10%. And after 1 or 2 quarters, they may grow 12-14%. So as of now, the aggregate earnings growth is 9-10%. Therefore, it would be reasonable to think that over the next 2-3 quarters, or at least till the end of the year, you're only supposed to make another 5-6%, which is 1% per month kind of return will be great. I mean, it won't come every month. What I mean is, you can't say today that we are in an environment of 20% growth, market appreciation. But hopefully next year, by the time interest rates come through and there is some government action on something to do with consumer, a little bit more, and in any case, because of monsoon or because of interest rates feeding through, the consumer sector also does better. Otherwise, we are looking for our consumer stocks which grow very high, but the aggregate numbers, of course, for India are quite limited.
Samir, hi, Rima here. So you're in India right now?
No, I was. Now
you were in India. Okay. So I'm guessing you must have spent a lot of time on ground. You must have met companies, investors. I mean, what were your big takeaways and what is the shift in the sentiment or tone compared to your last India visit?
By the way, I come every month, so that is not a big deal for me in that sense.
Right.
But then
the first part of the question.
The way I present it to people and to client distributors and even internationally is that you will make very below average return, like 10-12% or 10%, but it has to be compared with alternative, which is the interest rate. So if the government bond is giving only 6 point some percent, which say 9-10 years ago was giving 9%, so you are supposed to make a spread of 5-6% kind of range. So don't look at it in absolute that, oh my God, previously the market used to grow, earnings used to grow 14-15%, but now only 10-12%. Also for now, because the inflation is low, the nominal growth is low. And to the foreign investor, we say that you were broadly making at the market level, we used to outperform, but and still do hopefully. But at the market level, you are making 14% type and losing 3-4% on currency. Now you may make 11-12% and hopefully not lose much on currency. So in the end, everybody's happy and they move on by focusing also on the alternative and not just looking at the nominal number, which is lower than we have seen in the past.
Hi, Samir. Good morning. Good to see you. When I thought Surbhi will ask you about Trump, because he's been making a lot of noise. You'll just completely ignore it. Yesterday, I think what was trending since the cricket game as well as Trump were trending, people are talking about whether or not he made a couple of calls to the bowlers and said, I got it done. Thank you so much for your attention, But that was on a lighter note. But what do you make of Trump's commentary?
So the first thing is that, in some macro sense, somewhere there is some angle. It might be geopolitics angle, which might lead to some problem or something that who's your friend, who's your enemy, are you in this camp, that camp. But from an economy point of view, because the exports to US are so low, and particularly from the stock market, other than these two textile companies or one which, we also own Gokuldas and all. Okay, these guys will follow what to do. But broadly, we won't even know exactly which stock to feel negative on from this angle. Look at the positive that today one of our other companies, Paytm, has sold some 4,000 crores of stock led by two American banks, Goldman and Citi, which I assume broadly means that the investors will also largely be foreign and maybe American. So today, if we find, I hope we do, that the number of investors or a large thing was bought by US investors, that would be like a positive thing to say, that even practically nobody is overly reacting to that. Either assuming that this is limited because of our economy and the weight of exports or share of exports, or that this is not going to stay for long.
Samir, this morning in your typical style, you have tweeted on IndusInd Bank, Bajaj Finance and PNB Housing Finance. Now, where Mr. Anup Saha joins PNB Housing or not, that time will tell. But do you think the
stock?
Yeah, that's what I want to ask you. Do you think the stock has overreacted to Mr. Girish Kaushik moving on? Is it providing a good entry opportunity? Because it's lost 20%, in a matter of 3 sessions, I think.
Well, people say we are not supposed to talk about stocks, but broadly we know that no CEO is worth that much. But, if it turns out that he's joining the private equity guys who sold the stock, that would be hugely negative, and I would also be very angry with those private equity guys. But if it turns out he's left for another job, now what can you do? But if in all these cases where you find that the management is good, but on their leaving, if the stocks fall 20%, then you have to take a new view that the management is not good, that they did not hand over that company fairly and squarely to the management. They did not deal with succession planning, or they made it more volatile by leaving, because your responsibility does not end on the day you just leave suddenly, particularly if you leave suddenly. So, but anyway, as of now, 20% looks a bit too much, I agree.
But, forget about the stock for a second, Samir. I have to thank you. I thank you online as well. Thank you for the humor. I just could not stop laughing after reading that tweet. No one puts it like you do.
Which one?
The same tweet, the same post we're talking about. Yeah.
So many tweets, I don't know.
That's also true. That's also true. No, but we're talking about the one that's on our screen, talking about these big ticket management changes at large financial organizations. Let's see. So we have the answer on IndusInd now. We have to wait by and see the answer on PNB Housing. But on IndusInd, and larger question on banks, Samir, one, we have the policy coming up. So, you tell us on financials if you're changing anything, retaining your stance. And specifically, do you think that this is going to be a case of buying a turnaround story? People love to buy turnaround stories in this market. Problem is, half the time those stories don't work out. So what do you think?
We also buy many turnaround stories, from Paytm to Zomato to delivery to whatever, to fintech also. But this one I am not buying right now, because, we have seen when there are these legal cases, one is just a results and growth, and one day they're becoming earnings and all that. But here there are, you've seen how cases come up 1 year later and 6 months later. And this is a bit more complicated. Plus in financials and in banks, we already have our exposure. Plus these things don't grow that highly, that at that higher rate that you think that you are fascinated by the fact that something in the economy, or not economy, but in habits of people is changing. So this is like a regular this thing. So I am not buying that.
So you're circumspect, and I completely understand where that comes from. This is exactly what we were discussing with Abhizir Divanji just a while back, that from this forensic audit to MCA to RBI to SEBI, there are too many pending inquiries.
And they drag for years, or 1 year, 6 months, whatever. Plus in this, we have enough exposure in this sector, so we don't need to try.
Got that point. Just to go back to the Trump issue that Nigel highlighted, I want to get your overall sense on this. Till now, when we were talking about why FPI flows are not coming. So first, they were not coming because the US market was doing too well. Then they were not coming because India earnings are maybe pedestrian, some will argue. Then they were going to South Korea. Is this going to become another reason? If there is this, cold tonality between India and US, will it make foreign investors more nervous?
By the way, the foreign flows are coming from Feb 1. If you see in aggregate from February 1, the flows are positive. This month, they were negative for 2 reasons, I think. One was the Trump tweets or whatever. And second was the results did disappoint a few people if you looked at them individually. But otherwise, because of the big picture thesis of the entire world, and also mine, that the world is diversifying away from US in terms of their equity exposure. Currently, the MSCI World, the US weight is very high, maybe some 68, 70%. And everybody seems to be feeling that although US as market is doing well, but for different reasons, maybe because of currency, because of otherwise, the world is looking at non-US also. One reason may be that for the first time in many years, the MSCI World ex-US is beating the US market in pure performance. You can see that in the nervousness about dollar and the appreciation of gold and these books like Ray Dalio's book on how countries go broke. That there is some nervousness, maybe there is anger, maybe there is frustration towards US. So there is some X%, small bit, large bit, some move away from US, which for the rest of the world then becomes proportionately very high. Means if 3-4% leave US out of 70 or whatever, that for the 30% weight is a 10% increase. So in that, India has a story. You can be one day behind, 1 month behind. If China gets more than one day, you will get because you are part of that emerging market. But even otherwise, if you call primary plus secondary together, India is getting flows since Feb. The real selling happened in September 24 and in Jan 25, which was together in 2 months, something like 22 billion. But after that, it's not been in your face selling.
Got that. So Samir, one sector in India which you think is overhyped, and one sector where you think perhaps consensus may be getting it wrong and it could be a little under-owned, undervalued.
So overhyped, I've always said these new businesses are normally overhyped. I have read many books on this, particularly the solar theme. They might be great for India. We need it for climate, but for investment, these things never work. And even IT is still overhyped. Even today, people say that the valuations have reached long-term average. If you have reached long-term average, that means there were periods when it was below average. And what were those periods and why today should be a period which should be below average considering the uncertainty in US, the fact that companies are themselves admitting there is firing, that companies are not in aggregate hiring people while in the same city, some GCCs are hiring in massive numbers. There is a disruption going on. But because we have in the past seen great returns, nobody's willing to give up so easily. So that hope has to be, I think, brought down a little. In terms of another one, I think overhyped is the stock market related stocks, which is the exchanges, the depositories, the brokers, because we know that the government intent is to bring it down. We know that people have lost money. So beyond a point, we see that in the participation in the accounts of all these guys who come up every day and disclose how many active accounts, everything is falling. And we know broadly that if people lose money, then sometime or the other, they will drop out of this. And this has happened in Korea in the past where there was some frantic this thing in the olden days and then suddenly it disappeared one by one. And in a few years, you became a normal this thing. It's also a macroeconomic issue. I saw the interview of, Ashish Gupta of Axis with Lata saying that it is more than a stock market issue. It's a macroeconomic issue. I believe he was saying that it is 5-6% of India's savings that the F&O traders are losing every year, which is a big number. And most of it is going abroad. So that makes it even worse. By the way, it neutralizes the entire tax cut that was given by in the budget, which was, say, 1 lakh crore. And broadly, the public has lost 1 lakh crore. And not only they have lost, if they had given it to some other Indian or to me, I would have spent it in India. They have given it to guys who have taken it out of the country story over. So now they want another tax cut or a GST cut so that they can give it to Dream 11 or give it to F&O. It is not a stock market issue. It's a macroeconomic issue. And it, one way or the other, has to be brought down.
Okay, and just one more, the other part of the question. Any sector which, according to you, is grossly undervalued in India?
I don't know about grossly undervalued.
Little undervalued.
But the thing is, people are more cynical about the new age companies not realizing what change is happening. So the change is that these are the only few stocks, because they're not sectors, where we are not relying on end growth of consumer or end growth of insurance or end growth of logistics. But the shift in your either, if it's a retail thing, in your personal preference in buying from route one or the other, in buying online instead of from agent, or buying through quick commerce instead of going to your store or whatever. And these things can go on forever because these things are early in the game. The end with the businesses where you have to rely that India's growth will go from 6.5% to 7.5%. Those things will take time and you need many more things to fall in place. But the cynicism is, and that's why, I don't even own a lot if you see the portfolios. But just to irritate the system is so much fun via Twitter that I enjoy both the returns and the irritation I provide.
Oh gosh, and in these new age businesses, at least the Paytm bet, like you said, I mean, things seem to be improving. At least the numbers seem to be
Everybody
improving.
is improving. All of them
Paytm,
are
And even Eternal for that matter.
old age. You see, we are young people, so we relate to these new businesses.
Absolutely.
With Paytm, Samir is also enjoying Prince chart with, that was the other one he put out on Twitter.
Absolutely. But okay, to sum it up, Samir, before we let you go, so what you're saying is expect 5-6% return for the rest of this year, which is 1% return per month, which is too less by Indian investors, expectations. We're used to bull markets.
Tell them sorry.
Tell them sorry. What about if the RBI comes in and obliges with another, 25, 50 basis points this year? Do you see the bulls charging again, or is it just 1% per month?
No, this year, okay, but not now. Because if they do, then my bank's earnings will fall a little bit more for now. Because as they cut, it makes it, you need another 3-6 months to get everything in place. By the way, I have one more quick suggestion that what India should do. I thought about it in the morning, that we have to follow the Mark Zuckerberg policy. So what is our strategy? His strategy is, I will hire these individual guys from different companies in AI and make my own company. I think India should target 10 US companies and target them in the sense, bring them to India, bring Tesla to India, bring Disney to India, bring Harvard University to India, give them 200 million, 500 million.
Tesla is already in India, and Disney.
No, not that. For opening one BKC, that is not India. Tell them open, we give you 500 million, give Disney 500 million open. Basically make the American companies invest in India while the Americans...
bring them to India like that.
While
okay.
the Americans want Indians to invest in America or the world to invest, you call Harvard University and say, we give you 250 million. Open a campus. You call Universal Studio. You call New York Public Library. Give them 200 million. Come and open 6. I mean, do something big with only $4-5 billion, but focused on deliberately US.
You think they can stand up to Mr. Trump? Maybe that's a debate for another time. They'll get a call saying, "What are you doing, Mark?"
No, if they don't want,
like he called him Mr. Tim Cook.
Then you can call Oxford University. First, you try US. I mean, what I mean is, you have to change that discussion.
Yeah.
And it won't be a lot. Maybe $500 million on 10 companies, $5 billion. What's the big deal? And obviously, you won't give it outright. It'll be based on you spend 80%, we'll give you 20%. But basically, somehow make a list. Just like Zuckerberg made a list of employees who has to target. And he targeted them, and then some of them agreed. You also target X number of companies.
Think big. Yeah. Absolutely. Think big always.
And focus.
Okay. All right, Samir, good to have you on the show as always. And congratulations to you, Alok, Dinshaw, as well as the team on the outperformance with regard to the Flexi Cap Fund. And look forward to having a drink with all of you all towards the end of the year. Hopefully it ends on a high.
In the meantime, you can invest SIP.
For 1% per month. Got that.
Got that, Samir. Look forward to meeting you and chatting up with you. Thanks a lot for joining in. Well, let's focus on a corporate then. Shree Cement, the numbers look quite disappointing. The volume degrowth is something the street didn't like. We have Neeraj Akhoury, the managing director at Shree Cement, who joins in on the show. Hi, Mr. Akhoury. Thanks a lot for joining in and speaking to us here at CNBC-TV18. Tell us about this volume degrowth. The last time around you joined it, you told us the focus is on profitability rather than on chasing volumes. And that's the way it's played out even this time around. But now the degrowth for the first quarter is 7%. Earlier, you were talking about a mild 3% volume growth for the year. Does that hold?
Good morning, Nigel. I think you have to see it from both ways, Nigel. One is that in terms of prices, we have grown by about 9% YOY, or even in terms of EBITDA per ton, we have grown by roughly about 45%. It has been a very conscious strategy that we have been following. which we call value over volumes. A part of that strategy is now playing out. We are seeing that at this price, new price positioning, also our volumes are stabilizing. So I would strongly argue that the strategy which we have adopted is the right one to take the company in the future.
Right. That's the strategy that you have adopted, and maybe it could bear fruit as well.
Yeah.
But what is the guidance from here on? Earlier, you were guiding for ballpark close to 3% volume growth for the year and 6% realization growth, which meant that the revenue growth would be close to around 9%. Maybe you stick to the 9% revenue growth. You can clarify on that, but maybe you change both these two, variables.
No, we will stick to the same numbers, Nigel. In fact, on volumes, we would see now, in our view, we should be growing about 4 to 5% on the annual basis, around those numbers. And other numbers, what we have said is what we will be planning to achieve in the year.
So 4 to 5% volume growth still you're guiding for after seeing a 7% decline in the first quarter. So then you have to make up, big time. What does it do in terms of your profitability?
That we have taken this strategy for the last 6 months. And now it is playing out. Now our acceptability at the new price positioning is gaining ground. We are seeing the volumes in the key counters returning back. So with all that in having around, we believe that a 4 to 5% volume growth is the right number to look at.
So 4 to 5% volume growth, your revenue growth will be ballpark close to around 9%.
Yeah.
And you believe that volumes will make up from here on. What about your EBITDA per ton? That's something that you held on to. You said you'll be in that vicinity of around 1,400 rupees per ton.
Absolutely.
Even though you degrew, you still managed that number, which is commendable because you didn't have operating leverage that's playing out.
Yeah.
For the year, 1,350 to 1,400 rupees per ton, you can hold on to?
Absolutely. So I think 1,350 to 1,400 is the right number for the full year that we should be able to deliver.
And you think this, you would have clearly lost market share in the first quarter because of the strategy that you've adopted. Lower volumes, the industry grew in, mid to low single digits while you degrew. So there would be some market share lost. According to you, what is your current market share? And will you recoup the market share you had in the past?
So let us see how the future plays out, Nigel. But we were at about 8%, and I think that we should be able to retain that. We are coming up with some new capacities. We have already commissioned some, and about 6 odd million tons of new capacity in India, and about 3 million ton in UAE is still coming up now. So market share in India, we should be able to maintain for the full year.
Got it. Are you interested in Deccan Cement, Mr. Kuri? One part of the street says that Mr. Bangur and team, they go and see a lot of assets, but they're not being very aggressive. They're just participating. They're not pushing hard. Deccan Cement, that's the last one that we have heard that it could potentially be on the block. Have you looked at that asset? Is there any interest? And even JP Cement, the last time around you said you will focus more on organic growth. These two assets, do they fit the bill? Will you look at that?
As I have always said, we will rather grow through organic routes. And if you look at the last 2 years, 3 years, our growth is organically is about at 35%, much higher than the industry growth numbers in the same period. Acquisition, we are interested, but we have to get the right value at the right strategic fit. Otherwise, we will continue to focus on our organic growth route.
Okay, Mr. Parth Jindal as well yesterday at the press conference said he rather do it organically, but he said, I'm not going to tell you all how much I'm adding capacity at because then our competitors will know, how low the capex spend is for them. So that aside, we'll have to see how that pans out. Now, the UAE operations, that's always been a drag, but this time around, it's turned around very, very well. Impressive showing. What changed so much with them? And now you're getting confidence, you're going ahead and adding capacity. Has there been change in sentiment? Is there some kind of reason that these numbers are looking so good?
So we had done a huge amount of changes in UAE, be it in our operating methods, in our management, in our approach to market. All that has worked out very well, Nigel, for the last 1.5 years, 2 years now. And that is why we are seeing the results. UAE performance now is is exemplary to in our mind. It's extremely good, and we are seeing that with the kind of products that we are offering, the market demand is there, and therefore a capacity growth plan has been initiated.
So these numbers are sustainable, you think?
I think so. I believe so, and I'm convinced about it.
Okay, all right. What about the cash in your books? The last time around, you all were thinking about how to reward your shareholders. You know, I think a few years ago, you all were getting peak multiples. The street was very, very happy. Now they believe that maybe the aggression is not there. Though you all have focused a lot on pricing, and that's paying rich dividends. Is there a buyback in the offing? Is there a one-time special dividend? Because your cash balance would be what? Close to 6,000 crores or thereabouts?
About 7,000 crores, yeah.
7,000 crores, so something for the shareholders, maybe a small buyback.
So, I really can't comment on this. This is a board decision. We will take it at the appropriate time. At this moment, as I said, we are fully focused on how do we reach our 80 billion ton capacity additions, capacity in the next 2 years. We are already exploring many more sites where we will start work this year. So, for the time, I think we are more convinced about investing that money to grow the company to 80 million tons.
Okay, all right. So, you know, both these two assets you're confirming you're not interested in, right? JP as well as Deccan Cement.
I would not say I'm not interested. I have never made that comment. I would continue to say, Nigel, that Shri will like to evaluate every opportunity.
And where will you be most keen, sir? Where will you be most keen? Because there will be probably a large conglomerate going by what we saw with Holcim. Probably Heidelberg at some point of time comes to the market because of what the global parent has decided. And that could be strategic in nature in central India.
Very speculative, Nigel. So I would not like to comment on that. Heidelberg is a strong player and they are doing well in India. I am not aware of any such strategy that they have taken of exiting India. I'm not aware of it. But for now, I would fully focus our entire efforts on how to grow organically. And as and when opportunities come, of course, we're going to evaluate them.
Okay, all right. You know, going by what the parents' commentary is with regard to emission, you know, and where they want to head, probably the cement assets, you know, in India will be something that we'll have to look forward to. But let's see how that goes. For the time being, we'll take your commentary on the organic growth plan. The growth of close to around 4 to 5% in terms of volumes, holding on to your market share of around 8%, and a EBITDA per ton in that vicinity of around 1,350 to around 1,400 rupees. Thanks a lot, Mr. Ukuri, for joining in and giving us all of those details. Wishing you a good quarter ahead, and we look forward to chatting up with you. For the time being, we'll slip into a short break. On the other side, we'll have the international trade expert, Abhijit Das, and the former finance secretary, Subhash Chandra Garg, who will be joining in to talk about Trump's tariff threat on India.
Welcome back. Now decisively lower. It's 24,600 in the Nifty. We opened flat, but now we've lost close to about a half odd percent. DLF is the top Nifty loser. The bookings numbers were good. 44% jump in Q1, but the stock is slipping. BEL, Adani Enterprises, IT stocks taking it on the chin. Infosys losses more than about 1%, and Reliance Industries too is quite weak in trade. But the big story is US President Donald Trump took to Truth Social last evening, and he said, "We will substantially raise tariffs on India over its purchases of Russian oil." Following the US president's tariff threat, India has issued a strong response, a very strong response. Parikshit is now joining in with more on this. Parikshit.
The Indian government has tried to set the record straight with the US. They've gone on to say that the actions being taken by the US administration and the European Union against India for purchase of Russian oil are absolutely unjustified and unreasonable. And India will continue to take all measures necessary to safeguard national interest and also economic security. India has tried to remind the Trump administration that we started buying Russian oil after the war began because traditional supplies were being diverted to Europe. Secondly, the Biden administration at that time had encouraged India to go ahead and buy oil at the price cap because it was necessary for strengthening global stability in crude prices. Remember, there were no sanctions on India at that time for the purchase of Russian oil at the price cap that had been decided by US and European countries. Indian imports are necessity compelled by global market situation. That's the word coming in from the Ministry of External Affairs. The government has also said that it's very revealing that the very countries who are criticizing India right now and taking action against India for buying Russian oil and energy are themselves indulging in trade with Russia. For example, European Union imports of energy in 2024 had reached a record 16.5 million tons. US continues to import uranium, hexafluoride, palladium, fertilizers, and chemicals from Russia as well. So India is trying to set the record straight before a domestic audience, but it's also extending an olive branch to the US by saying that we are buying more oil and gas from the US. In fact, crude oil imports from the US are likely to go up by 150% year on year in FY26 itself. The trade negotiators will be talking later this month, but the word coming in from industry bodies and experts is that there is a need to dial down the rhetoric. It is important to have some clever diplomacy on the table and look for ways to save and protect this long-term strategic partnership, which is very critical for India.
Thank you very much for that. We're now joined by former Finance Secretary Subhash Chandra Garg. We also have with us Abhijit Das, international trade expert and former head of Center for WTO Studies. Gentlemen, thank you very much for joining in. Mr. Das, let me begin with you and the latest heat that we're feeling from Donald Trump. In the past, you've said that, this is Trump being Trump. His aggressive rhetoric should not be taken seriously in a way. But now it's just increasingly getting more and more provocative. What are your latest thoughts?
Thank you for having me on your show. Trump being Trump, as I said earlier, he will try to use the big stick in terms of tariff threats to extract as much of concessions as possible. He has already struck almost one-sided, hopelessly skewed deals in his favor with European Union, with Indonesia, with Japan, and a few other countries. He's trying the same trick with India, and it is to the credit of the government that so far we have stood very firm. Showing any weakness in front of the threats being shown by Trump could have consequences not only in the agriculture sector, but could have implications for access to affordable medicine, could have implications for our digital future, could have adverse consequences for even for sectors such as MSMEs through meeting demands of the US on government procurement. In a nutshell, Trump is using the tariff threat for extracting one-sided concessions, for trying to make sure that the policies in various countries, including India, are aligned, are changed to do just one thing: promote the economic and commercial interests of the United States. So that's where we are.
Mr. Das, Mr. Garg, good to have you on. Let me bring in Mr. Garg into the conversation as well. And sir, I just kept reading and rereading the lines yesterday, the MEA statement. It was quite telling, you know. Till now, and it's been, what, 3-4 months. We've just maintained stoic silence, or not really engaged with any of the rhetoric. But yesterday was a very clear and very specific call out in terms of what the EU is buying from Russia, what the US itself is buying from Russia. So where does this leave the hope for some sort of a trade breakthrough? This looks like a bit of a logjam. Your interpretation, sir.
So you issue a statement bringing out the fallacy or that United States, EU, all are doing business with Russia, and they're asking us not to do it. Now that contradiction, etc., is aimed at what? It's aimed at telling the United States that don't try to fool us. Let us be clear about you are doing business. Let's also do business. Is that the intent, or is that the intent is that all right, now we have seen through your game, and we'll also not be any longer looking at the kind of deal which we have been trying for the last 3-4 months. So I don't know what exactly is the message being sent, but in my judgment, Trump, everybody now knows, is not only transactional, but he negotiates on the moment. That in this particular moment, what does he want? A couple of months back, he was against Ukraine in favor of Russia. Today, he has turned completely against Russia and is in favor of Ukraine. So that is something. It's very difficult. So to do a deal with a mercurial person like him, he has his objective, and unfortunately for the world, he has succeeded in wielding this tariff bludgeon in such a way that he has got what he wanted to get. Most of the world has given in to his ask. So whether it's EU, Japan, Indonesia, Vietnam, etc. So I think he sees today that tariff is a very, very good weapon in his hand. And he can make the recalcitrants like India also to fall in line by saying that 25% is one, but I'll put you under much more of a penalty kind of thing. So I think you can't have a negotiation under such a situation. It's like a storm. When some storm hits you, you don't do a deal with the storm. You try to weather it out. You try to see that it passes through, and your damage are limited. So in my judgment, what is today needed is that we should sort of call this bluff out of this tariff threat.
Yeah.
Let us look at our interests. We have $85 billion kind of export to them. 40 is exempt in any case, the electronics and other things which have a different trajectory. It's about $40 billion of the trade which is at risk of the tariff. In my judgment, if you don't offer any concession to United States on this, even if there is a 10, 15, 20% kind of loss, I think we'll be able to call this bluff out of the tariffs. That is the way to go rather than trying to find a deal with.
Mr. Garg, the point is taken. Don't chase a deal with the US given the unpredictability and the mercurial nature. But while India's overall share might be low in US trade, there are certain sectors where the cost of inaction will hurt them greatly. So it may be $40 billion overall, but it's restricted to certain sectors like textiles, for instance, gems and jewelries. So isn't that going to greatly hurt these sectors if we don't do anything and strike a deal? They may get impacted severely.
See, if you do a deal, let us say you accept 25% tariffs on textiles, it wipes out all your profits, all your margins. Then what are you gaining out of that export? So if you are, let us say, making 15% and you reduce your prices by 25%, what is that export worth? if that reality is recognized, and so this will tell you very clearly that in this situation, that if you're faced with 25% tariff, it doesn't make sense to export to textile to America. So what do? Suppose you have some surplus left and Americans don't accept. Then you either use that for our factories to use that in the domestic market, or take it elsewhere where there is no this 25% kind of thing.
No, absolutely. But sir, the counter to that would be coming in obviously from the specific segments that get impacted. And I think the textile folks have already reached out saying that they want some help with duty drawbacks, etc. And then there's a question of penalty. So 25% plus, we don't know what penalty he's thinking of. Let me quickly go back to Mr. Das for the final word on this. Mr. Das, the issue seems to be that we're stuck at multiple fronts. I mean, this is not just about tariff, line-by-line tariff negotiations at all, right? I mean, there's market access issue. They want to bring in GM crops. Then there is the Russian oil issue. So do you see any scope of a middle ground?
Honestly, a middle ground does not exist because Trump does not believe in a middle ground. Trump believes only in his own ground, and he doesn't want to concede anything to the other party. So in all likelihood, any deal which we might end up striking with Trump could be hopelessly tilted against our interests. And let's not forget that these tariffs, which are illegal from the WTO perspective, are also being challenged in the US courts. So should we be conceding huge ground, giving concessions just out of fear that Trump will block our exports through these illegal tariffs when at a subsequent date, let's say a few months down the line, these tariffs have to be withdrawn by Trump because they are illegal? I think at this juncture, prudence suggests that we hold on. We should not be making unilateral concessions. We should not be we should not get cowed down by the tariff threat. We may have to endure a bit of pain, but in the long term, enduring that pain works better in national interest than giving concessions which Trump is demanding of us.
Yeah, absolutely. That's a point well made and well taken as well. So perhaps India, one of the few countries that actually hasn't, quote-unquote, bent the knee, as the EU is being called out for, and plenty of local opposition there for the deal that they've done. Thank you very much for the perspective that you've shared with us this morning. Appreciate you joining in. Well, with that, let's quickly get back to the market. The market, which could not really sustain with the opening gains at all. I mean, we are practically giving back, I think, 70% of yesterday's rally. 110 points lower on the Nifty now. Mitesh is back with us, and Mitesh has been cautious about yesterday's rebound as well. Mitesh, what now? What's the call? Index and stocks?
I've been talking about the Bank Nifty. Now, the Bank Nifty is just around yesterday's low, 55,437. And today we are at 55,470. So about 30 odd points away from yesterday's low. I think in that bridge, you could see some pressure on the Bank Nifty. Disclaimer, we have some put spreads over here. So there is already a negative position which I've taken. But I do expect, once 55,400 goes, there could be about 500, 600 point kind of decline on the Bank Nifty. And with that, I have a sell on HDFC Bank. That's a key component of Bank Nifty, and it's turning slightly weak, after making new highs and showing first signs of profit booking. So sell here with a stop just above levels of 1995 and look for a target in the range of about 1945, 1950 to begin with, and maybe even lower. And the second stock which I have, that's on the buy side. AB Capital yesterday had a big breakout bar. Today is giving a mild pullback. So if you get it around 274, 273, take long positions with a stop below 268 and look for a target of 285.
Thank you very much for that. Let's get to some stocks which are on the move. Godfrey Phillips is zooming on the back of a very strong Q1 performance. More than a 30% top-line growth. Manglam joins in with the fine print.
Well, it's a 37% top-line growth that Godfrey Phillips has showcased in the first quarter. And for perspective, ITC on a much larger base obviously showed cigarette revenue growth coming in at 7%. For the last 13 or 14 quarters, if I remember correctly, Godfrey has been outpacing ITC. And prior to that as well, barring 3-4 quarters, it has actually steadily continued to gain market share. Now, ITC obviously saw a margin decline as well, and Godfrey wasn't any different. So EBITDA for them grew at 25% at a time when the revenue grew by around 38%, and as a result of which margins came down from 25 to 22.7%. The street doesn't worry about that because a 38% revenue growth and them gaining market share definitely has the street excited, and the net profit, despite margins compressing, actually grew over 25% as well. 285 crore turned into 356 crores. The additional kicker that came in was the company announced a bonus of 2:1. So that's another thing that is leading the stock higher as we speak. Good numbers, bonus, and also them gaining market share.
Well, that's right, Mangalab. And when Philip Morris came out with their set of numbers, actually it was very disappointing from Philip Morris's perspective. But their commentary on India was quite good, which hinted that maybe, in fact, these numbers could be a little bit better. And as we speak, the stock is racing away till around a 10% gain. I recall on Bazaar morning call itself, we had made this point that Godfrey Phillips, the read-through from Philip Morris actually was positive. The stock is reacting in a positive manner. IndusInd Bank, that's the top Nifty gainer. Let's revisit the news of the appointment of Rajiv Anand as the MD. Gaurav joins us to tell us more. Gaurav?
Well, yes, Rajiv Anand will be taking over a position of MD and CEO in IndusInd Bank from August of 25. Now, RBI has given an approval for the appointment of Mr. Rajiv Anand as MD and CEO. And remember, CNBC-TV18 was the first one to break in this story that Rajiv Anand can be a front-running candidate for IndusInd Bank CEO and MD. When we look at the track performance for Mr. Rajiv Anand, it has been strong. He has been in the industry for over 35 years. And before joining IndusInd Bank, he was Deputy Managing Director for Axis Bank. He was also handling wholesale business banking there. And he was also one of the key person who was responsible for the digital banking there. In fact, he was also one of the founding MDs for Axis Asset Management in 2009 for 4 years. So definitely a strong track record is where he is coming from. And given the fact that he has a strong track record and experience of handling a bank which is bigger than IndusInd Bank, it is actually cheering up the market. In fact, this all started on 29th of April when Mr. Sumant Katpalia, who was MD and CEO, resigned from IndusInd Bank, and from there, in the 3 months itself, we are seeing this turnaround happening in the MD and CEO position. When we look at the overall uncertainties, now they still remain, but one part of the uncertainties is actually going away because of the appointment of MD and CEO. And this is what the brokerages are also penciling in. Now, Jeffries is saying is that the reorganization of the top management is one of the key things, which is key initial steps. But from here on, they will be watching out from any other joiners from Axis Bank or any other bank. In fact, Citi is also saying that from here on, there will be key things to watch out for, which includes strategic roadmap, execution capabilities, and ability to turn around the operating profit. Now, remember, ROA has been below 1% for IndusInd Bank, which is one of the cause of worry for investors, and that is the reason why we will be watching out on how the ROAs will turn around from here on. But definitely, as of now, good news is that Rajiv Anand is joining in, and as a result, we are also seeing stock is also cheering in day to day.
Thank you very much for that. We had a new listing today, Aditya Infotech. Its market cap post the surge is about 7,900 crore, and it's had a fantastic debut, 50% up right now. It had raised about 1,300 crore rupees. Subscription was 106 times. Look at that, 51%. It's a company which manufactures surveillance products and services and systems, so your at-home IoT, CCTVs, etc. Good debut. Get into a break. On the other side, Manisha will join in to talk about commodities.
Welcome back. Let's talk about the commodity markets now. We have Manisha joining in with the latest. Manisha, what's on your radar?
Well, I'm looking at gold after very many days, Surbhi, and that is because with all these geopolitical concerns and tariff issues, inflation, we've seen gold prices actually come stronger yet again. Overnight was above $3,400 an ounce. We've seen 1.5% of gains come in for the gold prices. Silver as well gained up by more than 1% overnight. Gold actually with that 1.5% has been the biggest one-day decline in 2 months that we've seen gold prices to perform here. Remember, for the months of April, May, June, even July for that matter, gold has been holding above $3,300 an ounce. Every dip is getting bought into. For the Indian markets, I mean, look at that. We're trading at a 1 lakh rupees, 10 grams yet again. We did see prices decline down to 96,000 as well. But yesterday was an all-time high in the New York session for the Indian markets. And we seem to be holding that magical number of 1 lakh rupees for the Indian markets, even at this point in time. Well, it has to do with the weak US jobs data. That has weighed onto the dollar index. The jobs data came in less than what the street was anticipating, less than what we saw in the previous couple of months as well. And the last 2 months also revised down is something that has seen that money flowing back in case of gold there. Also, with those numbers, the markets are now pricing in an 80% chance of a rate cut for the month of September. Well, the probability mills also tell you that 60 basis points of a rate cut is what, by this end of this year, is what markets seem to be pricing in. Markets as well as gold for that matter, and is the reason you're looking at that support coming in for the markets there. The US also had unveiled tariffs between 10 to 41%. That takes effect from 7th of August. Ahead of that, there's a lot of conversation coming in from banks and brokerages, revising their gold forecast on the higher side for this year and the next as well, also seems to be really supporting the markets. The global banks also have expressed concerns over near-term US growth, inflation outlook. Some of them have been talking about recession fears as well. Again, supportive there. And then it has to do with the Fed statements as well. San Francisco Fed president says that time for rate cut is approaching. Markets took cues from that. And then you also have Governor Adriana Kugler's resignation, where the markets believe that it gives President Trump chance to nominate replacement of his choice, are some of the things that the markets really seem to be reading. Citi was the only one, as we've been telling you, which have come in with bearish sentiment in case of gold prices. But they have revised it on the higher side now. In the next 3 months, Citi believes that prices can go to 3,500, 3,600, 3,800 is also what they're anticipating. In focus now for you to watch out going forward is going to be the June trade data, ISM PMI report numbers from US, and that is where the US dollar and gold will take cues from.
Okay, all right, got it, Manisha. Thank you very much. Well, on that note, we do have to take a very quick break, but when we come back, Lata is going to be in conversation with Goldman Sachs economists Santanu Sengupta and B. Prasanna of ICICI Bank on what the RBI could do in the policy tomorrow.
Welcome to It's the Economy. We are 24 hours away from the monetary policy, and the growth picture has gotten a tad more disturbing, with the US president reiterating even higher tariffs on India. Now, with inflation already undershooting, does this growth scare give the Reserve Bank another reason to cut, and perhaps cut tomorrow itself? That's the question we'll be asking. The market will also want to watch out for other indications other than rates, like, for instance, liquidity. I have with me B. Prasanna, head of global markets at ICICI Bank, and economist Shantanu Sengupta from Goldman Sachs. Gentlemen, good morning, and thank you very much for your time. Shantanu, I noticed that you have cut the GDP forecast because of this 25% tariffs, but it's by very, very marginal 10 basis points for the current year. Would that really prey on the Reserve Bank's mind? I mean, 10 basis points, 6.4% GDP growth, not a bad number.
Yeah, so the 10 basis points is because there's only 5 months left in the calendar year. On our fiscal year basis, we are at 6.1 compared to the RBI around 6.5. Now, I think what is important is what the forward-looking is on the tariffs. Our view is that this will likely not be the final word on tariffs, and as you can see, that there's been much progress overnight also. So we'll have to see where it finally settles at. I think the RBI will be looking at the mix of data. High-frequency data has been mixed. Rural economy doing well, urban. There's some signs of tepid data. Investment data on the private capex front, especially, has been tepid. And our sense is that the RBI might just want to wait out and see how things pan out over the next couple of months before moving further if they have to.
6.1, you said. My own poll had indicated 6.3, with everyone saying there is a downside bias because they had not yet factored in the tariffs. But just tell me, what do you expect the Reserve Bank to say in terms of inflation forecast? They are at 3.7. What will they say, and what will they say about growth, you think?
Our sense is that they'll have to bring down both the growth and the inflation numbers. I mean, inflation purely from a tracking basis, with the huge downside that you've seen in vegetables inflation, but more broadly, food inflation has been relatively contained. Our number is around 3% for the fiscal year and the calendar year. It could be a tad lower depending on where finally vegetables inflation settle at. I think they will also point out that core inflation has been inching up. The governor also alluded to it in the interview with you, and the forward-looking inflation is important from their standpoint. On growth, again, we think that they'll have to bring down numbers a tad bit. There's a huge uncertainty around growth given where this final rate of tariffs, and then there are like elasticity assumptions that you make on different products. Not everything will sort of get impacted in a similar manner. So I think with the uncertainty around growth, they'll have to bring growth down a little bit, but inflation clearly down towards 3% is what we would think.
Yeah, I think so. The poll, my poll indicated 2.9. So, coming closer to 3 is a must. Prasanna, therefore, a double question to you. If they don't cut rates, but bring down, inflation and growth forecasts, inflation substantially, how will the market react? If they cut rates, how will the market react?
So I think, Lata, either way, we do feel that there are things for the bond markets as well as yields and the market to look forward to. If they don't cut, I think they can't afford to speak hawkish in any case, because like you said, and like Shantanu pointed out, there is a downside risk to growth which has opened up. We have also kind of revised it a tad bit lower. Plus, there is a twist in the tail in the US Fed as well, now with almost certainty that there will be a 25 bp cut in September, and followed by a reasonably larger rate cut cycle, maybe extending for 125 basis points till next year. And the fact that inflation is going to surprise RBI earlier estimate by nearly 100 basis points in Q2, and the average inflation for the year going to be at around 2.9%. They need to bring it down by 80 basis. So if you look at all of this, plus the fact that the high frequency indicators have slowed down, the possibility of a rate cut has opened up. We would say that a rate cut between the August policy, which is tomorrow, and the next policy is almost 100%. Now, it is a toss-up on what the RBI really wants to do. Do they want to front load? I mean, this dispensation has been clear that they want to front load and give a fillip to growth as soon as they cite the space opening up. So do they do that? Or do they wait for a whole lot of other data like the GDP data, actual GDP data, then the Fed action and all that, and delay it further for next 2 months? But to answer your question more directly, I think either which way bond yields are headed lower marginally. But I have to say that as far as duration is concerned, there is not a significant large move that we expect though.
Okay. When Prasanna says duration, he means the 10-year bond is not, the yields are not falling much. Whatever changes you see, I guess you are expecting more in the T-bill and the 10-year and the 1-year level, right, Prasanna? That's what you meant.
Yeah, maybe up to 3, 4 or 5 years.
You may see yields fall.
Yeah.
Okay. Now, am I right that both of you are expecting the Reserve Bank to cut forecasts but not cut rates? Shantanu, is that your position tomorrow?
Yes, we don't think there's a rate cut tomorrow. We think it is likely later in the year, possibly in the October meeting, maybe the December meeting, depending, again, on how things pan out. But on forecasts, we think that, yes, they will likely cut both growth and inflation numbers.
And that's also your expectation, Prasanna, right? No cut, but cut in forecast.
No, I'm not as strong in my views that there is no rate cut tomorrow like Shantanu. I think between tomorrow and the next policy, there will be a rate cut. You cannot discount the possibility of a rate cut tomorrow. The governor
intermeeting? You mean intermeeting rate cut?
No, I'm talking about RBI.
Yeah, I know. You're expecting RBI may cut between August and...
No. Between the policy...
Okay, either this or that.
And the next policy. So it's either the August or the October.
Okay, I might tell you that our own MPC voted just 3:2 in favor of a pause, like Shantanu. So very narrow vote. And likewise, Ritu's poll, which we will shortly present, is also indicating the market is very narrowly placed between this or that. But what else will you watch out for, Prasanna? We know that it's a small change, whether the governor cuts and right away or sounds dovish so as to cut on September 30th is a small change. But what will you watch out in terms of other impulses from him?
I think if he doesn't cut rates, then what I'll watch out for is a language that he's using to, justify a neutral stance. I think earlier, the neutral stance clearly came across as a hawkish stance where the rate cuts are not likely to happen. And that's the reason why the market felt that there is nothing forward-looking to look forward to from a policy perspective. But I think tomorrow the language that the governor will use will be very important. And the second thing is, of course, a whole lot of questions on liquidity. While RBI has been doing a very good job on managing surplus liquidity, and when liquidity gets taken away, also announce, short-term 1 and 2 day VRRs to give liquidity back. They've done a commendable job. But I think maybe clarity on what the liquidity policy framework is going to be in terms of usage of instruments and in terms of what are they targeting as a size of the liquidity surplus, and whether weighted average call rate versus SORR, which is the rate that they would likely to use for monetary policy targeting.
Okay, I don't know if they will say that all. They may give away the liquidity report, and maybe that will indicate. But yes, the market really wants to know whether are you watching TREPS or are you watching call rate? The charts will come up. Shantanu, guide us? What should we watch out for in the governor's language? Which sentences, which paragraphs?
Yeah, in our view, the language is much more important for tomorrow. If you think about the June meeting, they cut 50. Ultimately, financial conditions tightened through rates, both long rates and short rates being higher. That is because they moved from accommodative to neutral. So if you look at financial conditions in India from the previous meeting up to end of July, there's actually been a net easing only from the FX channel, right? Because your FX depreciated, or the trade-weighted dollar, trade-weighted INR depreciated. That is the only thing that really eased all financial conditions for you. Everything else tightened, including equities. I understand for the last couple of days, given the rhetoric on tariffs, again the market is pricing in a little bit of easing. But therefore, our point is that the communication tomorrow is much more important than whether they deliver the 25 basis points of rate cut or not. So let's say, and Prasanna hopefully will agree with this, that if they cut tomorrow and the market gets the signals that this is the end of the cycle, I would imagine that the curve will steepen and you'll not get a lot of transmission apart from what you would be getting in any case from the EBLR channels. And therefore, the market needs to believe that there is hope for something more to come, but not yet fully delivered. And that communication is important for transmission to go through in our view.
Actually, I was fishing for that answer from both of you, that tomorrow actually a cut will not be as dovish as a dovish talk and no cut, because that keeps expectations alive. Just a final question, Prasanna, currency, yaar, it's went all the way to 87. I mean, our low is 87.97. What do you, will that prey on the Reserve Bank's mind? And in any case, what is your forecast, say, over the next quarter?
No, I think the currency spot depreciation is not likely to prey on RBI's mind. It's not done from a policy perspective so far. So I would like to believe that they will continue with that stance, that the currency rate will be a reflection of the macros and flows. As far as the what we think on INR itself is concerned, I think it's been unfortunate that even as the dollar weakens and even as the dollar weakens against most of the other developed market currencies, current account deficit countries and India in particular have not been able to enjoy that tailwind, primarily on account of the significant outflows or the lack of inflows in both FDI as well as in FPI. And hence, and also you have a huge short position in the forward dollar market, which the market knows that the RBI will be looking to recoup and close out at some point of time when inflows come. So RBI has turned out to be a buyer when the dollar flows come in. And also, unfortunately, because of this rhetoric on tariff actually increasing over the last 1 month or so, this actually means that the rupee needs to depreciate in order to regain the competitiveness from the exporters' side. So I think a little bit of depreciation is in the order, and most of the negative things seems to be coming. The only saving grace is oil is still very low and heading towards 60 due to OPEC considerations. But on the other hand, if the Russian-related oil spike happens, then there could be an uptick in oil. So the forward-looking view on oil also is a little bit not very clear. So from that perspective, I think there is a little bit of a depreciating pressure on the INR.
Oh, that's an important takeaway, depreciation of the rupee on the cards. Thank you very much, gentlemen, for laying all the cards on the table. We would know, of course, in 24 hours what the RBI thinks. Wrap up on Bazaar. Chartbusters coming up.